Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Victor Adair, recently retired from nearly 50 years of being in the brokerage business in BC, but he's still very active in the markets. Welcome back to the show, Victor.
Well, thank you, Jim, and Happy New Year to you and all your listeners.
Victor, bond yields have been rising for the past 6 weeks. Is that because of rising inflation or the Fed's plans to change monetary policy?
Well, it's a bit of both, and those things are sort of one and the same. But let's put this in perspective. The 10-year U.S. Treasury, which is sort of the benchmark for bond yields everywhere, was trading at about 1.3%, I guess, in early December. And this week it hit 1.9%. So that's a substantial move in bond land. And when you have a big move like that in a major market, it sends ripples everywhere. For instance, the German 10-year bond traded above zero yield this time for the first time in 3 years. In other words, for the past 3 years, the nominal yield on a German bond has been negative, let alone, the real yield. And speaking of real yields, of course, that's what you get after you take your bond yield, subtract out inflation, and see what you got left over, if anything. Real yields have been negative for, well, certainly since, I'm not going to say 1918, but 2018. But as nominal yields have risen, so have real yields. But in the United States, the 10-year is still about a negative 60 basis points. But that is the best it's been in certainly the last 9 months or so. So rising interest rates, why are they rising? I saw a note today that Christine Lagarde, who is heading up the European Central Bank, said that, she doesn't want to be ruthless, that's her word, about raising interest rates in the Eurozone like they are in the States with the Fed, because she thinks that, the interest rates rising a bit the way they are just sort of reflects a stronger economy, and she wouldn't want to get in the way of that. And it's got nothing to do, in effect, and that's my words, not hers, with strong inflation that's happening in Europe. So I think the bond yields have been rising. I think the market has been seeing that basically the Fed stayed too easy for too long. They just really opened the floodgates with stimulus following the COVID panic in March of 2020. Governments, of course, also stepped up, so, everybody was getting paid. And all of that stimulus was, certainly goosed the stock market, took bond yields to, the low they've been in recorded history, basically. And now we're getting, the bounce back from that. And certainly the Fed was not only perceived to have stayed too easy for too long, but as a result of that, they might have to panic a bit to get out in front of rising inflation. And then there'd be one more thing, and that would be positioning risk. A lot of people had been positioned on the Fed staying easy. Certainly the stock market was kind of anticipating that, although people would be looking over their shoulder. But as interest rates have started to rise here, that sets up a condition whereby people who've been long of that market start to feel the heat, get their feet held to the fire, and then ultimately or eventually, they start to sell, and that, of course, means to people further down the ladder than them start to panic as well. So positioning risk has really come into play here, like across markets as we've started this year. But I think maybe the granddaddy of everything here has been for years and years and years, we've had low, and lower interest rates, and maybe the signal we got from the Fed in the December was a sea change in that trend, and that if we are now going to see interest rates not stay low or get any lower, that changes the calculus on anything and everything.
Stock markets had a great year last year, but they seem to be on the defensive so far. What are your thoughts on that?
Yeah, the stock markets, I mean, the two major indices we all pay attention to, the S&P and the Dow, both made new all-time highs the first week of January and have been certainly on the defensive since then. But, they're down, let's say, roughly speaking, 5% from all-time highs. That really doesn't even warrant being called a correction, but it's been let's call it the jitteriness, I think, of it that's maybe got people rattled a little bit. Certainly we've seen other markets, the NASDAQ maybe down 10% or so, and the Russell small caps worse than that, maybe 15%. But what we call the inside of the stock market, that's like, the indices, particularly all the major indices except the Dow, are weighted. So when you have the big capitalization stocks, the Apples, the Facebooks, the Googles, that sort of thing of the world, Microsoft for sure, they have been the lion's share of the indices, and they've held up better or gone on to make new highs, as Apple did, than a lot of the smaller stocks in the indices. So we've had this breadth within the market that's been deteriorating, certainly from December, but really showing up this year. And another way that deterioration shows up is in what we call the rotation, as money moves from one aspect or one sector of the stock market to another. And, in the big sweep of things here, we have seen some of the, call it favorites, of the last year when, the froth or the speculative froth was really raging in the market, so people were buying what we would call crap, companies that weren't producing any revenue but maybe had a nice gleam in their eye and someday would be something. They've been hit much harder than, good, solid companies. We take a real bellwether for that has been Cathie Wood's ARC, which has a collection of great little companies in her ETF, but they're not making any money and, may never make any money. So that ARC basket of stocks down about 50% from last year's highs. As we go further ahead here, I think people are trying to figure out, what's going to happen. It seems as though maybe, the worst of COVID will be behind us shortly if it's not already. Maybe there's going to be pent-up demand for people to go out and buy things, not only goods but also services, go traveling and all that. And maybe the economy is going to do better. I'm outlining a bullish case here. And that, if the Fed bumps up interest rates by 1 or 2%, that's not the end of the world. So there's a lot of, let's say, jockeying for position in the market. So we're having, big intraday moves in the stock indices as well as in the credit markets, as people are trying to, say, adjust to the new reality. I'm a short-term trader for most of my trading. So, these kind of markets are great for me where they're just kind of chopping up and down. And if I catch little swings and then be able to get out quickly. For folks that are trying to, balance a portfolio, this kind of jitteriness that we're having here is probably a little tough to take. And on that front, one thing we're seeing right now is that stocks and bonds are both falling together. And that's really a problem for a lot of the classic sort of 60-40 portfolios where, you get 60% in equities, hopefully diversified across a number of markets, and the other 40% in bonds. And the thought there is if the stock market has a hissy fit, the bond market's probably going to rise, so you'll have some protection. But there's a subset of that called risk parity, where they take that 60-40 idea and they lever it up. So in a market like we have here now, where stocks and bonds are falling together, the risk parity guys are really getting hit. So I think some of the selling we see, and the selling kind of comes into the market in waves here on short term, some of the selling has got to be people that are either, getting margin calls or they're having to rebalance and reduce their exposure. So what I call positioning risk has been really adding to the chop or the wild short-term swings that we've had as we go into, this year to date.
Crude oil prices are at 7-year highs, around $85, $86 a barrel. That's a jump of almost $20 since mid-December. What's going on there?
Kind of the same thing I said about I think the look forward to what's going to happen. The thought that maybe COVID's kind of behind us, that we're going to have the economy start to reopen, to use that term. People will want to get out and do things, spend money on fuel to go places and that. I think that's part of it. I think along with that is this idea that we've got low inventories around the world. In other words, there's not a lot of crude oil sitting in tanks everywhere. It's relative to historical levels, we're low. And the margin of safety, let's call it, if demand was to really surge, there's not a lot of spare capacity in the world that could be brought on stream, let's say with higher prices or just to meet demand, that we would have a situation as we go further into this year where the lack of backup inventory to meet demand just isn't there, and that could really accelerate the jump in prices. Of course, bigger picture-wise, one of the reasons maybe there's not that backup supply, in inventory, is the attack on fossil fuels by the green movement generally, and the fossil fuel folks haven't put the money into building inventories because they're looking ahead and thinking, the world isn't going to want, use, or it'll be outlawed to burn crude oil in any form or other, 10 so years in the future. So, why go to massive expense to bring on new inventory? So I think there's that. We're seeing really steep backwardation in the crude oil market. In other words, front months are trading at $85. You go a year forward, it's $75 a barrel. That helps as well to put pressure. Now, one thing, and I guess also we've seen, oil stocks have really jumped here in tandem with crude. We had crude really get clobbered back in Thanksgiving, the end of November, the American Thanksgiving. And it was a peculiar time, like on that Friday, the Thanksgiving Friday, when the markets are normally sleepy, nobody's really there, everybody's home eating turkey and all that. I think we had crude fall $10 that day. So I kind of look at that as a bit of a freak episode, and we recovered from that. So if in a way you took out that $10, $12 tumble we had over the Thanksgiving period and just say we got back to that, then the rise we've had here from early December wouldn't look quite so dramatic. In other words, the trend from where we were, say, a year ago to now would have been just pretty much a steady run to the upside. One more thing I got to say on that. U.S. shale production, which has been a game changer, for American energy independence, and not only crude oil, but shale production for natural gas. The expectations here is that shale production in February will probably hit 5 million barrels a day, which will be a new high. So, the old story about one of the best cures for high prices is high prices, because high prices, create production. Now, you hear folks will say things like, well, you can't print crude oil, like the Fed can print money the way they can. But, you get prices high enough, and ingenuity around the world will help find crude oil to meet demand. So, nothing's a layup in terms of you figure something out and, it's a sure thing. We have some pretty wild moves here, big moves in interest rates, big moves in stocks, and obviously a big move here in crude. In fact, I think that's been sort of the big move the last 6 weeks or so. And that run-up in crude has also pulled the commodity indices up to a new 7-year high. So there's lots going on in the markets that I'm trading.
England announced this week they'll soon be phasing out COVID restrictions. How is that announcement going to affect the markets?
You know, I actually went and dug up a video of Boris Johnson, the Prime Minister, announcing in Parliament what they were doing, because I just had to check it just to make sure it was true. I'm probably overreacting, as I often do, but that's a game changer in this sense. I mean, England had some pretty draconian lockdowns compared to the United States, at least. Maybe not as bad as Australia, but still. And now they're just saying, we're done. Now, that's not exactly true. There's going to be some restrictions, but relatively, we're done. And I think that will happen elsewhere. You know, that'll happen in the States. Whether, you know, it's already been happening in a way in Florida and Texas, say, that'll happen in Canada. So I think the market, you know, very quickly is processing that, and adding that to the plus column in terms of society reopening, you know, new demand for things out there, travel, goods, services, that sort of thing. So, to me, it was a bit of a surprise, given how draconian they've been. But maybe, and again, it's politics, you know, maybe it's just Boris Johnson, who seems to be in the doghouse in more ways than one, is getting the people on his side by making that announcement.
Sure. Well, bring your own booze and your best buddies with Boris, it seems.
Yeah, exactly.
We'll have more with Victor Adair right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Victor Adair. Victor, you were bullish on the U.S. dollar for most of last year, but it has been steady to a little weaker the past few weeks. Have you changed your mind on the greenback?
I'm kind of in neutral right now. Maybe 10 days or so ago, I bought the euro currency. It had been trading sideways in a real narrow range, and of course the euro makes up effectively about 70% of the U.S. dollar index, so it was kind of the flip side of the U.S. dollar. And I was looking for it to break out of the range. It did that, and didn't have much follow through, and I took profits on the position. But I saw this quote attributed to Christine Lagarde that I mentioned earlier. I saw that today, where she was really kind of putting her little foot down and saying, you know, we're not going to be pushed into raising interest rates like those crazy Americans. And again, those are my terms, not hers. And, you know, the euro has just fallen right back, you know, the range it was in. Part of the strength of the U.S. dollar, particularly in the second half of last year, the strength relative to other currencies, was that American interest rate and American interest rate policy were higher than rates elsewhere, and that helped draw capital to America. Now, I also think, just like in the late 1990s, that the red-hot stock market in the United States, which was hugely outperforming the rest of the world, also helped draw capital to the market. You know, if you're sitting in some country somewhere and you say, look at that red-hot American stock market, I want to get in, you got to switch your currencies your currency into U.S. dollars to buy it, mostly. So there was that. Now, in the short term anyway, the bloom's off the rose on the race up in the stock market. Interest rate spreads are maybe, okay, that's yesterday's news, and so, you know, what have you done for me lately? So the U.S. dollar has kind of traded a bit sideways. I think if the tension from a weakening stock market mounts, that puts a bid in the U.S. dollar, as people want that for safety. To some respect, you know, the classic havens like the Swiss franc and the Japanese yen may also get a bid, and the Japanese yen has been like most of the currencies, but the yen was really weak against the U.S. dollar last year. So if the yen started to get a bid, it could have a bit of short covering come there to help it along. I don't have a position right now. I certainly pay attention to it. I'm very, very keen on paying attention to what happens to the major currencies. Let me segue to the Canadian dollar, which has certainly for more than the past month has tracked absolutely, almost tick for tick, WTI. I mean, WTI has run up much more strongly than the Canadian dollar, but still, Canada's going up, and it's been very closely tracked to WTI. I even said to somebody the other day, it's like it's the poor man's crude oil. Like we used to say, silver was the poor man's gold. The Canadian dollar has ignored really weakness in the stock market, and previously, or a good part of last year, the stock market was well bid, then Canadian dollar had a bid as well. And there's virtually nothing in the way of interest rate differentials that are going to be important between Canada and the U.S. But, and as I said earlier also, the WTI, being as strong as it has pulled the commodity indices higher, and Canada, on a 20-year chart, you look at Canada, you look at the commodity indices, they're very closely correlated. So, if you're bullish commodities, you also want to be bullish the Canadian dollar. Now, that's generally speaking clearly not a timing tool. To come back to your question on the U.S. dollar, yeah, I was definitely bullish last year. About this time last year, we just had that the mob breaking into the Capitol building in Washington, and that was the low day for the last 3 years. For the U.S. dollar, it was kind of the blood's running in the street, and the U.S. dollar did better for the rest of the year from that point. So at the moment, I'm kind of ambivalent about the U.S. dollar. I could see it going either way, and if I see it going one way, I'll try to get on that move.
Gold and especially silver have jumped the past 10 days or so. What do you make of that?
Yeah, they have jumped. I mean, a $3 move in silvers, that's pretty spectacular. I mean, that's about a 15% move, something like that. A bigger move than in gold. But they're still both in kind of the ranges that they've been in for the last several months. And in let's say over multi-year kind of periods of time, silver kind of tags along behind gold. I mean, it has its own factors for sure, but in the big picture of things, silver tags along behind gold. And the thing that I've paid a lot of attention to over the past couple of years about in the gold market has been the ETF market for gold. The reason I pay attention to that is, I trade gold in the futures markets, and a lot of the futures market traders are on a very short fuse. They're in there for a good time, not a long time. Whereas the ETF players, I think, have a longer term time horizon. And we've certainly seen over the last decade or so a buildup in the net holdings around the world of gold ETFs. And they hit a high around the time of the COVID panic in March of 2020. And gold peaked out a couple of months later in July, I guess it was. But for the last 18 months or so, the gold ETF folks have been selling gold. I think the amount of selling they've done is probably the most we've seen in the past decade or so. Now, there's still a substantial chunk of gold, and I'm sorry I don't have a substantial tonnage of gold. I don't have the figures right in front of me, but it's on my blog, I think, with last week. But people with a longer-term view on gold have just turned their back on gold for the last 18 months or so. Now, if gold starts to get bid higher again, I think those people will be back quickly. I don't think I think that the bearishness of that has probably played out. And I think maybe the market action here in gold and silver the last 10 days or so reflects that, relative bearishness has played out. So, but I'm still thinking it's within the past couple of months here, it's still in a range. The relative strength or weakness of the U.S. dollar is always important to gold. Gold has struggled a bit with rising interest rates, and particularly rising real rates here the last 6 weeks or so. But, you know, maybe the worst is in for gold. I'm interested in it here as a buyer rather than as a seller, but I haven't taken a position.
Commodity indices are now at 7-year highs. China is an important source of demand for commodities, but its economy seems to be slowing. What are your thoughts on China and on commodities? After all, lumber seems to be on a bit of a charge again.
Yeah, lumber has been, and as mentioned earlier, the commodity indices have made new 7-year highs, although energy, particularly crude oil or fossil fuels, have a huge weighting in the commodity indices. So the run we've seen in crude really pulls those higher. China is, let's say, it's always depending on your perspective, and I understand the thing about who do you believe and all, but let's just kind of go at it anyway. I mean, the real estate sector over there is so huge, it's unbelievably huge. You know, that is where most of Tom, Dick, and Harry in China have got their wealth invested. It's the real estate market. And of course, the real estate market with Evergrande and now some of the other big developers struggling. The real estate prices have come off, and I think that's a subset of what has been called the common prosperity moves of the government over there, where they're, I think, in a way, trying to discipline some of the guys who maybe the government thought were a little too big for their britches. And we've seen, some substantial drops in share prices, particularly in the tech sector in China. The economy seems to have been struggling relative to what it used to be. Now, by the way, just before I carry on here, we've got the Olympics coming up. I think they start on the 4th of February and go to the 20th, and I think we have to figure that there's going to be, well, let's say it this way. We might see a different China once they got the Olympics passed, okay? But to come back to this, we are seeing, unlike the Federal Reserve, the People's Bank of China is easing monetary policy, well aware of the drag on the economy from the weak real estate sector. I see China is actually burning a record amount of coal right now, and 2 months ago or something they were trying to tell people don't burn coal because we want clean air here for the Olympics, and I guess they figured out where their priorities were. So it's kind of like who knows what's going on there, and how do you trade it anyway? I mean, starting back in, let's say, 2000, 2002, for the next 10 years, I mean, China was the commodity market. It was just the biggest run-up in commodity prices ever, as they took everything that wasn't nailed down. So, yeah, they're certainly important. But, there's just so much going on there from a political point of view, and I've just had this thought for so long that there might have been some similarities in the incredible run-up in Japan in the 1970s and 1980s, where their stock market peaked out at the very end of 1989, beginning in 1990, and for the next 3 decades, Japan has kind of shuffled along in some sort of a slow motion depression. That maybe there are some sequel here with China having had this explosive growth, but all kinds of let's say unintended consequences that came from that might make the economy slower going forward than it had been in the past. So I don't think that's a very direct answer to your question, but sure, China is important. It seems the economy has been slowing. The authorities are easing a little bit, but maybe it's not the same China that it used to be. I mean, I guess if you're like a sales guy and you're trying to sell people on the idea of buying some copper derivative, you point out that there's 500 million people over there that haven't got around to buying a car yet, and when they buy one, it's going to be an electric car, so therefore the demand for copper is going to be incredible. Well, I mean, that's, for me, that's kind of like cocktail party conversation as opposed to a trading idea, because, that just got too many loose variables on it. I'll be watching it, but, sorry, Jimmy, I guess I can't answer it any more directly than that.
For almost every market, there seem to be bullish experts and bearish experts. How do you take into account with varying different points of view when you do your trading?
Well, isn't that a perfect question given what I was just saying? I've been trading for 50 years. I mean, all those years ago, I was trading penny mining stocks on the Vancouver Stock Exchange and getting my quotes by looking at yesterday's newspaper when I was, off in the woods somewhere. And certainly we've got somewhat more sophisticated since then. But one of my views has been that there's just so much going on that no matter how clever you think you are, you have no idea. Okay? And that's not just me trying to pretend to be humble because it's politically correct. That's just a fact. That's just how I feel. One of the, Donald Rumsfeld was the defense secretary under George Bush, I guess it was. And he used to talk about the unknown unknowns, things that you don't even know you don't know, that sort of thing. When I trade in these macro markets that I trade in, there are folks that are trading in there that I've just got no idea who they are, what they know, how much money they got, what their time horizon is, on and on and on. And I may have an idea that the market's going to go up, and I buy it, and it goes up, and I might think, well, gee, I was right, that happened. The going up might have had absolutely nothing to do with my idea. It might have been something else entirely that I wasn't aware of and may never become aware of. So, having said that, I have noticed for 40-plus years that there's almost always experts who will tell you where they think the market's going, and so often these experts disagree. And, a lot of these folks are either, selling newsletters or they're paid economists or whatever, and that's what they're supposed to do, tell people where things are going. And every once in a while, they get it right. And depending on, what follows up from that, they may become rich and famous or not. But let's say they're all maybe got more resources than I have and more education or more experience or whatever. So the experts are experts, but, oftentimes they're just dead wrong. In a way, the difference between those experts and me as a trader is that when I'm wrong, I just say, oh, this isn't working out, and I get out. So the way I go about trading is I do read lots and lots and lots of experts on both sides of the case. And I'm always looking for an idea, and I might be reading some piece of research and get an idea, the thing, okay, so then if that's what that guy thinks, then if this happens, such and such would go and I can make a trade. But almost always I'm doing that for kind of background ideas, but my actual trading, I want to get into a market, either a buyer or seller, with a trade that's in the direction of whatever the short-term trend is. If I feel as though the market's made a low and is starting to rise, I want to be a buyer, and vice versa. And it's all going to be contingent on the time frame I'm looking at. I can have a little more confidence to stay with that position if I feel as though some of that reading I've done tells me that there may be more to go. For instance, if I form an idea that let's see, everybody and his dog virtually is bearish on a certain market, and it starts to rise, and I'm on the long side of it, I'll feel better about that position because I'm thinking those folks that are short this market are going to have to come in here and start to cover their position, and that just may add to the rally. That'd be what I call really understanding positioning risk and the flows, so that whether people that are currently long have to sell or the other way around. Those are very important impacts on the market for the duration or the time frame that I'm looking at.
Victor, thank you so much for chatting with us.
Hey, Jim, it's always fun. There's never any easy or complete answers, but we just try to try to get into sync, I guess, is the thing, with the flow of price action, and I would also caution our readers just to be careful about chasing something, and that's fresh in my mind because this week started. I'd had a busy weekend with family. We had basically a 3-day weekend with the Martin Luther King holiday on Monday, and I was a little late, as it were, getting back on the job. And I wanted to be short in the stock market, and the stock market was kind of getting away on me to the downside, and I just had the discipline, I guess, to not chase it. I thought, so if I sell it here, then I'm going to take quite more risk than I want if the market reverses on me. So I eventually just said, okay, I'm not going to do that. If you find yourself in a hurry to get into the market, whether you're buying or selling, it's probably better not to act on that because then you're not getting in a good position.
Thanks again, Victor.
Jim, it's always a pleasure. Talk to you again next month.
I've been speaking with Victor Adair, a recently retired but still very active broker. His website, victoradair.ca. If you have any questions for him, you can send them to us and we'll ask that question. You can send them to info@howstreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.